Hello, I'm Jessica Amir for the Finance News Network. Joining me from Shaw and Partners is its Chief Investment Officer, Martin Crabb. Today we're talking about markets, reporting season and what sectors to watch. Martin, thanks so much for coming back.
Great to be here.
So 2018 financial year, we've seen markets hit a 10-year high despite trade war fears. So much is going on. How would you describe what's taking place in 3 sentences?
It's a pretty amazing performance the last 12 months to June. Market up 13%, not too many people would have picked that. And that's despite the 2 biggest sectors, or 2 of the biggest sectors, banks, was actually down 1.5% for the year, and telcos, which a lot of people own, is down almost 1/3 for the year. So despite that, the market was up 13%. So all the other heavy lifting was done by those sectors that typically are selling stuff offshore. So miners, energy, healthcare, and food and beverage companies, all up 30 to 40% last year. So a pretty strong performance.
And Martin, what opportunities do you see for Australian investors on the back of the US and Chinese tariffs?
That's a good question, and it's a bit of a tough one too, because there's about $13.5 trillion of global trade, and the sanctions that are being, the tariffs that are being discussed between China and the US could take the trade war disputes to $1 trillion. So that's a big chunk, and that's about 25% of all US exports as well. So it's going to get nasty, or it could get nasty. So it's very difficult to find winners in a war. In fact, in trade wars, I don't think there are winners. Now, the only potential companies that could do well are those companies that are avoiding the tariffs or are being exempted from the tariffs. Australia's been exempted from the US steel tariffs, so they could potentially sell more steel into the US, which would be positive. And another industry which is small globally but quite big in Australia is tree nuts, so things like almonds and walnuts. So California is the biggest exporter of those products globally. If they have tariffs put on them, then that opens the door for those companies. So Select Harvest and Webster are 2 of the biggest nut producers. So there's only a handful of companies I can see, Jessica, that actually win out of this trade war.
Turning to earnings season now, what's Shaw and Partners expecting in terms of standout stocks or sectors?
Again, it's been a pretty mixed market, as we said sort of at the open, telcos going backwards and so forth. But we think the profits of the market will grow somewhere around 9 or 10% for the year, which is a pretty good result. But it is very concentrated. So it's in things like technology and energy. So those 2 sectors, we think energy profits will double in the past 12 months. Because the oil price has gone from $40 to $70 a barrel, and also the technology sector. So we're seeing more and more of it every day, whether it's payment systems or people using cloud technology or so forth. So we think those 2 sectors are the standouts. But in terms of individual companies and sectors, we think construction and engineering. So these sectors were bombed out a couple of years ago with the mining crash and so forth, but they've really bounced back strongly. So civil construction, engineering, infrastructure spending, those things are doing quite well. So things like Bingo Industries and maybe Emeco Holdings would be 2 results I'd look out for.
And when companies do release their results, a lot of them don't actually publicise if they've met or exceeded or failed to meet their results, their financial results. So how should investors really gauge if a result is positive or negative?
That's a really good question, and it's one that we, even in the industry, really struggle with. So what is the market already baked in, or what is the market already penciled in as a result that is good or bad, and therefore what is a hit or a miss? So this is really important to have a financial advisor or a stockbroker, because typically a financial advisor or stockbroker will have access to data, consensus data, that gives them a guide to what other analysts or what other investors are thinking about a result. So when it comes in at 100 and the stock price falls 5%, you look at the result and you go, that was up 20%, that looked really good. So obviously F&N does a fantastic job as well as getting the company CEOs in shortly after the result to talk through the numbers and give you a bit more colour. But again, you can see things move quite rapidly on the day. The market's normally right, but it doesn't really give you a lot of time to work out whether it's a good or bad result.
And over the past couple of weeks, the healthcare sector has been boding quite well. So for the financial year ahead, is this a sector that we should be eyeing, or what do you recommend?
The healthcare sector has been one of the strongest performers, and it's mostly on the back of CSL, which is the heavyweight. It's almost 5% of the index. That's now through $200, and it's up quite strongly. Can CSL continue to grow? We think it can. It's got large addressable markets and it's quite dominant in its space. Will it continue to grow at the same pace? It's hard to see that happening. It's also a little bit vulnerable because the PE ratio, or the valuation of CSL and other healthcare stocks, is quite high, because they have been the industries that investors have been seeking. They're high growth and global, And I think that maybe things get a little bit tougher from here. So we're still positive on the healthcare sector, but probably not as much going forward as in the past.
So what other sectors should we be eyeing for the rest of the financial year?
Yeah, we still like energy and materials. I mean, they've had pretty good runs, and there's a few speed wobbles at the moment with global growth sort of starting to slow down a little bit, we think. But we still think energy and materials are probably the go-to sectors. We're starting to swing slightly back in favour to some of the more defensive sectors, because we do think the easy money's been made. We talked at the year about a game of two halves, and the first half being strong and the second half being a little bit tougher. We think that's the case. So we think the banking sector's starting to look interesting. We don't think you're going to make a lot of money there, Jessica, but we think you'll do quite well.
And what are your expectations for dividend growth?
Not that great. I think profit growth will be lucky to be 5% next year. So, you can assume that dividends will grow 5 as well, but there's a couple of little nuances to this. One is the banking sector itself. The banks are all selling their wealth management and insurance businesses, and they're quite capital intensive. So the capital that becomes available then, the banks can use that to increase their dividends or do buybacks or both. So we could see some special dividends, maybe not in the next 12 months, but certainly thereafter from the banking sector. And another big company, BHP, is selling its shale assets. They might get $10 billion for that, and that will come back as a special dividend. So we think normal dividends probably just plod along, but there might be some opportunities for other capital management initiatives.
And lastly, Martin, what else should investors be watching out for?
I think the key word for us, Jessica, is diversification. That's what we've been banging the drum on all year. We think things will get a bit trickier from here. We think people have made very good money in share portfolios in the past 5 or 6, 7 years. We think it does get tougher. So we want to make sure our clients are invested across asset classes, across sectors, and across currencies to make sure they're very well spread and they're not reliant on one source of income, whether it's property or term deposits. We really want to see them spread their investments broadly.
Absolutely. Thank you so much for your insights, Martin Crabb.
Thank you.